Good afternoon. We are LeTigre Group at Oakwood Real Estate Debt Strategies. We are here today to discuss the Kenwood Retail Center. We'll go over the asset, our financial investment, the retail market, and our financial strategy going forward. For introductions, I'm Patricia. I'm joined by Stefan, Carrie, Patrick, Jay, and Jose. Who are we as a fund? Oakwood Real Estate Strategies is a debt fund. We aim for relative value investments. We aim to hold investments for 3 to 5 years, and we target returns of 9% or greater. These key facts are really important to understanding why we pursue the investment strategy that we're recommending today. Kenwood Retail Center is a 342,000 square foot, Class A suburban power center on a strong retail road in a top 20 MSA. Recently, the operator, MacArthur Properties, has seen 3 vacancies due to corporate bankruptcy. As such, they've asked us for a loan modification on the mezzanine loan that we have given them. In assessing this modification, we considered several options, and we have decided that we would prefer to remain in the mezzanine position and have provided a counteroffer. Our counteroffer has 3 key factors. First, we want to increase our security in the investment by adding the 12 out parcels on the property to the collateral. Second, we want to attain an equity kicker of 20% to realize greater returns. Finally, we want to increase goodwill with our sponsor by offering to assist in $1 million of their paydown to the senior debt. We are confident that these 3 factors present a strong strategy for realizing higher risk-adjusted returns on our investment. Financially, we have provided a $20 million mezzanine loan behind a $40 million loan from Jamestown Bank. This mezzanine position fits right within our target investment strategy, again, getting back to that 3 to 5 year hold and those 9% returns. Visually, here we see an illustrative map of the asset with the tenancy when we invested first in 2015. Given the recent departures, it now looks a little bit more like this. Despite these changes, we are still confident in the underlying asset and the value going forward. Given the strength of the asset, the evolving retail landscape, and our investment strategy, we are confident that our counteroffer is a win-win-win and offers the opportunity to limit risk and capture upside. With that, I'm going to pass it off to Patrick to discuss the evolving retail landscape.
Thank you, Tricia. So, if you look at articles in newspapers about the current status of the retail industry, this is the image that's being depicted. This phenomenon is called the apocalypse. The apocalypse is a theory that e-commerce is going to replace and take over the entire retail industry, and that brick-and-mortar stores will become obsolete over the next couple of years. Investors have not been fully insensitive to the sentiment. Over the last half year, cap rates have gone up between 25 and 75 basis points, depending on the location and the type of the retail asset. However, if you look at the actual numbers reflecting the current retail industry, one may conclude that this is an opportunity to exceed expectations, particularly since expectations are already at a pretty low level. First of all, e-commerce makes up for less than 10% of the total retail industry. Second of all, vacancy rates have remained flat around 10% the last couple of years, and rents have been growing with 2 to 3% per year. Third of all, even though there have been a lot of store closures lately, net store openings have actually been positive in 2017. And fourth of all, and maybe most importantly, large e-commerce retailers such as Amazon are more and more focused on brick-and-mortar stores as well, in order to create synergies to web rooming, showrooming, and creating seamless omni-channels, which US customers prefer. Now, power centers have been least sensitive towards the whole negative trends surrounding the retail industry. Nationwide, there's a vacancy rate of around 6%, and rents have been growing with 2 to 3% per year. So Our philosophy is therefore think macro and act micro. The retail industry isn't dying, it's evolving. And I would say if you look at two of the most recent trends that we've been witnessing is, for example, food and beverages have been performing very well over the last couple of years. At the same time, the consumption of experiences have outperformed the consumption of goods by a factor 3 over the last 2 years. So taking these factors into account and having done an analysis on the lifestyle traits of the population that's living around Kenwood Center, we would like to see a shift in the tenant mix that's focused a bit more on food, beverages, and service-oriented tenants. Now, I was asked this morning whether I go to power centers on a regular basis. And I said, well, I've been. But that's I would certainly go more often if there were very cool restaurants and if there were very cool experiences at that power center. So with that said, I'm going to pass it on to Carrie, who's going to talk more about the asset underwriting assumptions at the property.
Thanks, Patrick. I think it'd be helpful to talk about where we are today. Currently, we're in 4Q17 of an investment that we made in 2015. Recently, as Tricia pointed out, a few anchors have vacated at the center due to corporate bankruptcies, dropping occupancy at the center down to 75%. In addition to the vacancies, Toys R Us, which is the anchor at the center, has expressed that it would like a rent reduction because it's struggling financially. From our perspective as the mezz lender, we're taking all of this into consideration and approaching the underwriting from a somewhat conservative perspective to ensure that we're protected in a downside scenario. So to start, Toys R Us. Rather than assume an aggressive backfill of the space at a market rent, we're assuming a more reasonable scenario that the sponsor negotiates a deal with Toys R Us at the reduced rent that's about 50% of what the tenant's paying today. Next, we were concerned about leasing risk and credit tenancy issues. To mitigate this, we assumed a more conservative vacancy rate of 8% relative to the market's 6% that Patrick mentioned. And then lastly, regarding the lease up of the vacant space, we assumed a discount to this space relative to the renewal market rate, given that rents have trended flat. Effectively, this works out to a 3 to 7% haircut on the inline and anchor suites. Additionally, we're assuming that the sponsor is successful in leasing up 80% of the inline space and 75% of the anchor space over a 24-month period. With our leasing assumptions, we're projecting a stabilization to occur in 2020, which is well within the fund's life of 2022. And to help contextualize our leasing assumptions, we provided a breakout of the NOI at stabilization. So this slide depicts each component of NOI at 2020, shows the existing tenant roster. We broke out Toys R Us, and that also shows the anchor and the inline lease up. As you can see on this slide, the 2020 number is in line with the 2015 estimated NOI, which gave us comfort in that we weren't getting too aggressive with our go-forward assumptions. So while we're comfortable with our go-forward assumptions, we wanted to make sure and do a gut check on the in-place tenancy and their ability to pay going forward. So this slide depicts the relative strength and creditworthiness of our in-place anchor tenants. As you can see, most tenants are performing well. They have above market health ratios and they have strong sales. Toys R Us, however, is struggling, and in mitigating that risk, the reduced rent will help and offset the risk of default. And so in sum, there are several risks at the property level. There's vacancies, there's existing lease maturities, there's credit tenancy issues, and there are market concerns regarding the flatlining rent. However, we feel we've mitigated our position through conservative underwriting, as well as the property's strong inherent fundamentals. It has great visibility and ease of access along a prominent retail street. It has very strong surrounding demographics, and they're below market in-place leases to recognize upside over the immediate to long term. And so now that you have a general understanding of how we underwrote the unlevered asset, I'm going to pass it off to Stefan to talk about our response to MacArthur and our preferred strategy.
Thanks, Carrie. So as Tricia mentioned, we provided this counteroffer because we believe it has the best risk-adjusted return in comparison to our other strategy options and within the scope of our fund's investment criteria and mandate. As I'll detail in a moment, we believe that this provides lower risk and potential upside, all while providing an olive branch to the sponsor. As you can see on the slide behind me, we have the sponsor's modification request alongside our proposed counteroffer. And to reiterate, we have three main factors here that we want to point out. First, we want to take 12 of the out parcels as additional collateral. Second, we want to retain a 20% equity kicker in the deal. And third, to provide a little goodwill, we're offering to pay down the senior $1 million in place of the equity putting up the $2 million of equity. Now, in order to better understand how we thought of some of these structural issues, we've actually grouped them together in order to better contextualize them within the scope of the larger deal. So I'll start with future funding. We agreed to fund $2 million in deferred maintenance, mostly as protective capital. We want to make sure that the asset is performing well and the tenants are happy. And second, we agreed to fund up to $4 million in TIs and LCs. We view this as good news money, but we also want to make sure that the sponsor is signing appropriate leases at appropriate rents. As such, we've also added lease approval rights and also debt service coverage ratio hurdles at the end of 2018 and 2019 to make sure that these leases are getting signed along schedule. Second, the mezz accrual modification request and additional collateral. So the sponsor requested a modification from L plus 800 paid current to L plus 4% paid current and a 4% accrual rate, which we've agreed to. However, in order to mitigate some of this accrual to our outstanding loan balance, we've requested a $5 million, we've requested the 12 out parcels as additional collateral, which we value at approximately $5 million, but have also included a cash flow sweep into a reserve account up to $3 million. And we've structured this in order to essentially match the amount of the accrual to our outstanding loan balance through the new loan term, which we've agreed to extend to December of 2020. And the third component is the equity kicker and the senior paydown. We thought about this in the sense that the equity is valuable. We wanted to offer an olive branch by saying we will provide $1 million of the $2 million paydown, so you don't have to commit to putting up as much equity. In addition, we're also asking for a 20% equity kicker in the deal, in case the sponsor is actually able to turn this asset around and get cash flow back to peak performance. Now, we realize that there are a lot of structural issues going on here, and they kind of all rely on one another. But as a package, we find this deal both attractive and fair to the sponsor, but also puts us in a position to take advantage of the situation that we're in and create additional value to our fund. So with this, I'll quickly touch on some of our returns, expected returns. We would expect IRR of 11.6% from initial investment in 2015, a multiple of 1.56 times, and $14.6 million of profit. This compares to if we were just to accept the modification as is, we'd expect a 9.6% IRR, a 1.45 times multiple, and about $11.6 million of profit. And of course, we've also added additional collateral in the $5 million value of the out parcels. So we additionally have a basis safety, making our position in the counteroffer even more safe. And of course, on a go-forward basis, our returns look even better. We would expect an IRR in excess of 30%, a multiple in excess of 1.7 times, and profits of over $4 million of all new invested capital. So while we believe that this is the best counterproposal that we can provide and has the best risk-adjusted return in comparison to some of our other strategies, we wanted to walk you through some of the other ways that we thought about this, and I'll hand it off to Jay to walk you through these.
So in addition to the proposed solution that Stefan's highlighted, we also explored three alternative courses of action in understanding how we wanted to respond to this loan modification request. The first is we could simply accept the loan modification request as is. And given our base underwriting, the return profile in this scenario actually roughly falls in line with our fund's target of 9%. However, most all of the alternatives here rely on a successful releasing execution of the asset's vacancies. Given this environment of higher risk associated with this releasing, we seek a solution that compensates us for this higher risk, with both higher returns and additional collateral protection of our outstanding position. And this first option offers neither of those two things. The second option is we could foreclose on the equity, take over the asset, and assume all releasing and operations. Given the flexibility of our fund to be opportunistic in situations like this, the higher return profile here was actually compelling for the fund. However, this puts us into a heavy operations role, which is really outside of the scope and expertise of our debt fund. It adds additional costs with having to pay down additional principal on the senior loan. It adds additional costs and risks with any sort of foreclosure proceedings that you're going through. It also brings up potential reputational risk with us as a mezzanine lender within the industry. If we become known as the lender who would rather foreclose on an asset, they come up with a creative solution for its borrowers. The last thing we could do is foreclose on the asset and sell, thus liquidating our position. However, based on our estimate of current in-place market value of the asset, it's likely we'd only recoup 75% of the $20 million outstanding position that we have here. So given the details that I've offered here, above, we think we've come up with a compelling creative solution here that adds significant risk-adjusted value relative to these other alternatives for both our fund and MacArthur as the equity. Now I'm going to turn it over to Jose, who's going to talk about how this experience has informed our view of investments in the retail lending space in the future.
Thank you, Jay. In the future, we believe that Oakwood should continue to invest in lend against retail assets with additional caution due to the changing sector. Future investment opportunities should focus on the specifics of each individual asset, and we recommend a strategic focus on Class A assets in top 20 markets with stabilized demographics and a diverse tenant mix, which suits the demands of the actual demographics for an area. A diverse tenant mix will additionally mitigate risk and also prevent overexposure to any single tenant. Investors should continue to seek out experienced operators and pursue deals that systematically reduce risk. For example, funds such as Oakwood, they should be wary of providing mezzanine financing to deals where loan-to-ratio values are over 70%, debt service coverage ratios are below 1.25 coverage, and always maintaining a conservative spread to cap rates, especially at entry. And we think that with additional consideration to the specifics of the asset, overall risk, and the deal structure, that investors will continue to realize risk-adjusted returns even as the sector continues to change. In summary, we believe that the market is writing retail's eulogy, but the sector is still showing signs of life. We're not ready to quit on retail just yet. Proceeding with additional caution, we think that there are still substantial returns to be able to be made. Finally, our counter to MacArthur's proposal reduces risk by collateralizing the 12 out parcels, secures a 20% equity return, and finally shows goodwill through a senior loan paydown. We understand that MacArthur can walk away from this deal. However, we believe that through the goodwill that we are showing, they will find this deal appealing. And ultimately, it allows them to stay in the game and realize substantial future profits. Ultimately, our counter limits our risk, secures our upside, and lies very well within the overall arching strategy of the fund. We are a LeTigre Group. We thank you very much for your time, and we stand ready to answer your questions. Thank you.
We've structured it as just additional collateral. Once we get paid down, we would not have any more collateral in it.
So when you sell, you're not getting 20%?
Yeah. That's at least how we've discussed it to this point.
Clarify on the pay down you're offering. I saw a slide where the borrower was $2 million and you were $1 million. But I saw somewhere else where you were going to take one of the $2 million. Clarify what that offer is.
Yeah, so to pay down the existing modification includes that the equity pay down $2 million of the senior. That's the base case modification proposal. Our counteroffer is to provide $1 million of that $2 million. So we would be providing $1 million, and the equity would be providing $1 million.
So what does plan B when they say that $1 million offer is pretty nice of you, and then by the way, you're not giving us that?
And sorry?
What's your plan B if they accept your $1 million
then it's a continued negotiation. Because the way that we've structured this is that it's one package altogether. And the reason that we actually included the $1 million of goodwill is because we didn't want to go back with them with all these requests, including $5 million of collateral, a 20% equity kicker, all these other structural control points without actually giving something back, so that at least we can have some sort of conversation.
So if he comes back and says, what I propose is the best I can do, what would you think?
So we've discussed this as well. If the options are take this modification as is, or just take the keys and you can operate it, then we believe that we would go with the modification. The way that we think about it, as Jay discussed, this is not something that we want to be owning and operating. This is not within the wheelhouse of our fund. And if you think about exactly how much the difference in profit we would actually be making by going through our counteroffer, it's actually only a 0.01 difference to what we would expect our overall fund return to be. So in order to take on that headache for that type of asset, we just don't think it's worth it. We would go with the modification request.
So as a lender, what is the priority here? Sponsor credit or the market? What's your most important priority for the state of this?
I would say sponsor.
But I think also given our expectations of the fundamentals of retail within this market, as we've talked about, the real issues that we've had here that's led to this 25% vacancy of the center, it's corporate bankruptcies. It's not necessarily location-based sales issues. And so I think our ultimate theme here is we actually believe in the market. It's just a matter of the market coming around and filling up the asset.
You mentioned that selling the property upon stabilization, but you're just the lender, so how do you enforce that or have the client sell it when it stabilizes as a lender? Do you have an agreement where they take you out and then sell it?
That was just the assumption for the model. At the same time, they could refi us out, and we would still retain our 20% equity kicker, but would no longer have the outstanding loan balance.
Can you share your concept of profit and how you calculate it?
Sure.
I thought I saw profit when you foreclosed and sold profit for less than your loan balance.
Sorry, that's our profit on top of our getting repaid. So if we got the,
Profit on your income.
yeah, the 14.6 million I think you're referring to, that's on top of getting back all capital that we've invested into the asset, both from a original loan balance of 20 million, as well as any TIs, LCs, the $1 million senior pay down, everything that we've put in, we'd be earning $14.6 million on top of getting that money back. Does that answer your question?
I'll sit tight.
Okay.